overview of what's been going on in the economy for US and Canada. Those two are very correlated. Today that I'm recording this video is January 5th, and today we had the labor market data coming out for US and Canada. So I'll discuss that. It basically came out above expectation. But I think prior to that, we should definitely discuss what happened on December 13th. We had the Federal Open Market Committee meeting, FOMC meeting on December 13th, and then following the meeting, we had the Chairman of Federal Reserve, Jerome Powell, coming out, and he had a little bit of a speech, and then there was a question period. And during the question period, he uttered the words interest rate cuts in the view. So I'm going to show you a quick clip.
In the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more. The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
And as soon as he said that, I think we basically witnessed a shift in the market. So interest rates for bond market started to go down in the US, and Canada followed. We had a rallying of the stock market. The market basically pressed in the fact that we'll be having not only just rate cuts, but significant rate cuts looking into 2024. I think it was a little bit premature. He even said that it is premature to declare any victory. Although today, after the labor market data that came out, I was reading on Bloomberg that we had Janet Yellen declaring U.S. economy has achieved a soft landing. And she's the Treasury Secretary. That did seem a little bit premature, but let's see what happens. On December 19th, as you can see from this slide, the CPI report coming out for Canada for November, and the headline CPI was surprisingly above expectation. It was basically the same as October, but the expectation was for it to come in a little bit lower, and that didn't happen. It was mainly attributed to travel costs, events held in US during November. But I mean, more important than that headline CPI was the CPI trend. You can see from this slide, Bank of Canada would follow this indicator more closely because that's a better indication of their policy rate decisions on inflation. And pretty much since the beginning of 2023, we were on a steady decline for CPI trend rate year over year. With a slight hiccup in August where we had 3.9% year over year, but after that we had 3.6 and 3.5 in October. For November, the expectation was for it to go even lower, but it didn't. It stayed at 3.5. That's literally the definition of sticky inflation. I was reading the RBC report where their expectation still remains for the first rate cut to start to appear second half of 2024, but they were also cognizant of the fact that the numbers, the readings, the inflation readings are still sticky. We had the labor market data coming out today, as I mentioned earlier. U.S. labor market data ended 2023 with strength. Payroll employment was up 216,000 in December. The year did end with a softer, more balanced labor market, but it was still, the unemployment rate was still below average, historical average. So historical average for US is about hovering around 5% unemployment rate, and we were at 3.7% in the most recent number that came out for December in US. And the reason that we want the unemployment number to go a little bit higher, even though that might sound counterintuitive, is because if the unemployment rate is too low, that's an indication that the labor market is too tight. It's very hard for businesses to find employees, to find workers, and that would put upward pressure on wages, which is a major contributing factor for inflation. We want those two to be a little bit more balanced, the supply and demand of labor. And as far as Canada is concerned, the unemployment rate was at 5.8%, still a little bit higher than the beginning of the year, so the labor market did soften up a little bit. But overall, report was mixed. We had a decline in full-time employment by 24,000, but then we also had a jump by 46,000 in professional services job. The decline was mainly led by retail and wholesale, and we also had an uptick for part-time jobs. I think more important than that was the fact that wage growth was still very strong. We had an increase of 5.4% comparing to last year for average hourly earnings. That's basically what we're trying to track from labor market data, that if the labor market is too tight, if the unemployment rate is too below norm, it would put upward pressure on wages. And so far, that has been showing resiliency. This chart is showing you the 5-year Canadian government bond, which has a direct correlation to mortgage rates. And it is true that month over month, we did see a somewhat significant decline for 5-year bond rates. I think we were at below 3.2% prior to the beginning of 2024, and then we did pick up a little bit. If this trend continues, we could expect to have a lowering of mortgage rates. The translation for that would be a higher prices for real estate market. I think it's very important because of the mixed messages that we're getting and the too many uncertainties in the market. For example, I'm very cognizant of the situation that's going on in the Red Sea. Basically, today we had container shipping rates coming at very elevated levels, and that's putting upward pressure on prices. How long it would continue, how much of an effect it would have, it remains to be seen, but it's an unknown factor. And then if this situation continues and there's upward pressure on container shipments, it could have an effect on future CPI readings. So we have to be very careful as far as anticipating how many rate cuts we'll be having into 2024. Moving on, I will be paying close attention to the CPI report that will come out on January 11th for US. That would be the CPI report for December. It would basically give us a clear indication whether we ended 2023 with a tamed inflation or not, because we had a little bit of mixed messages for November numbers. So that would be important. Looking into the rest of the month for January, we'll have the Consumer Price Index for Canada on January 16th coming out. You will have the Bank of Canada's policy announcement on January 24th. The expectation for that is pretty much to be a hold on the rates. And lastly, on January 31st, we'll have the FOMC meeting announcement again. And I think by the end of that meeting, after the question period, if Jerome Powell comes out saying that yes, we have inflation under control and we are very much looking forward to have interest rate cuts into 2024, then it would have an effect on bond rates, and it would be a different scenario as far as price strategy is concerned for real estate, versus having a scenario where he comes out and says, you know what, we're getting mixed messages, we don't know. So in my opinion, by end of January, we should have a clear idea in terms of what kind of a price strategy we're looking for, looking into spring market of 2024. Anyways, that's it for my economic update. I hope you find the information helpful. I'll also do a mid-month report for economy as well, mid-January. And if you have any questions, obviously don't hesitate to reach out. Take care.